Hello and welcome to Switzer on a day when the stock market was up 29 points on the ASX 200 index. Clearly a response to the Trump and Xi meeting at the G20 meeting in Osaka, Japan. Obviously the market is still confident and is still willing to go up even more. I'll be talking to Jun Bei Liu of Tribeca Investment Partners about what happened on the market today and what stock she likes going forward. And then I'm going to ask Michael McCarthy and Julia Lee to look at the 24 stocks that really copped a clobbering in 2018. But most of these have pretty high ratings for 2019 when you look at the Analyst and what they're saying on FN Arena. I want to ask both Michael and Julia what they think about these 24 stocks. And then we'll finish off with Peter Morgan, who was a top-line fund manager at Perpetual before he started his own company, 452 Capital, which ended up having about $6 billion under management. Peter's retired nowadays, but he's still an enthusiastic market watcher. And what he can teach you about picking stocks and understanding markets, well, he's one of the best. Well, my first guest today is Jun Bei Liu, Portfolio Manager at Tribeca Investment Partners. Jun Bei Liu, great to see you.
Good to be here.
All right, so the market today, were you expecting a positive day?
Look, we were expecting somewhat positive, but it did turn out to be quite good. Look, at the outcome of that Xi and Trump's meeting was mildly positive to what market was expecting. People worry about things will get worse and increased amount of tariff, and it turned out to be somewhat subdued. So the risk has pushed out much further, so the market is having a relief rally. So it's reasonably strong today.
Do you think when a trade deal is signed, if it is signed, it'll be a case of, well, we've already bought the rumour, now we'll sell the fact? Or do you think there still will be another leg up because there's not sufficient confidence that a deal will be had?
Yeah, I totally agree. Look, if the deal gets signed, final, market would definitely reach the next leg of growth. However, yeah, we just don't see that take place anytime soon because there are so many major issues that needs to get over. And of course, Trump is clearly using this as a bargaining tool heading all the way to election next year. So there's no need to sign the deal right now until much later on. So we see that to be signed much later on. And meanwhile, market will actually become a little bit more volatile. Initial relief rally, and they will see the earnings weakness given by that initial 25% increase of the tariff.
So what you're saying then is that those people are hoping to see a deal at least before Christmas, and maybe that give impetus to the usual Santa Claus rally, which rolls into January, February, March. Are you thinking that the deal could even be later than that?
There's possibility. There are some major issues, even though they haven't dealt with it yet, such as Huawei. The technology issue is the most sensitive and the big issue there, and as well as the currency and a few other things. And it's a bit difficult to see how that might play out. There's both sides of the argument. It could be negative, could be positive. So at this point, it's very hard to call. And that's why we expect the rally in the market to be somewhat capped because we don't know what the outcome will be.
Okay, so the people watching this would like to have the confidence that you have being a portfolio manager playing the market. So what is your script going to be for this market?
Look, I think this market is incredibly exciting because we're a long-short manager, so we can buy and we can sell, and to take advantage of this volatility. And we are seeing a lot of volatilities at the moment. So market rallying, you take advantage of that. And now next month is earnings season. So get right with what you're expecting with earnings outcome, because this is your opportunity. July, end of July especially, your opportunity to position for those. You want to buy the ones that potentially have earnings that's going to do better, and you want to short the ones that's not going to do as well.
Yeah. Now we're also seeing this is kind of like a crazy rally at the moment because it's defensive stocks that everyone's chasing. They're going for income-paying stocks. Is this going to be a trend until a trade deal is signed, do you think?
I think it's actually very interesting. Trade deal has some sort of impact, but the rally in some of those defensive, if you're talking about the yield stocks, that's what you're thinking of.
Bond proxies.
Yeah, bond proxy is partly because of the interest rate. Globally, interest rate is going so low.
But isn't that related to the trade
right.
deal anxiety
and absolutely.
economic problems?
But look, the world is very uncertain at the moment. Aside from trade deal, we've got Brexit, we got other geopolitical issue, Iran, and all the issues that's taking place. Just means central banks are not going to step up, which means it's well supported for a lot of those yield stocks. And our yield stocks in the Australian market actually look pretty reasonable value compared to the other markets, simply because of the interest rate spreads. Our banks, for example, it looks actually quite decent, even though they probably some of the yield will potentially be downgraded, just given some of the domestic pressure.
I thought that once we get a trade deal signed, or it could happen before then, that you could see a rotation out of these defensive stocks on the basis that, well, the global economy should improve and therefore let's chase cyclical stocks. Is that something that you think eventually will happen?
Look, when the deal is signed, initially you see that rotation very quickly. But when you actually think about the cyclical stocks, normally cyclical stocks are the resources. And the top resources stock, they're doing really well. So market is buying yield and they're buying cyclicals at the moment. So they're well supported. But if there's a deal, you see some of the underperforming cyclicals, other metal stocks potentially would do better. And some of the US cyclicals might do better.
What about small caps? Because they've been left behind as well, and there's obviously a lot of good quality companies that are being totally ignored. They're going about their business, making the same kind of profits or even better, but they're not being bought. Do you think when the risk is no longer the answer, is a risk-off situation, small caps might make a bit of a comeback?
When there's usually how the risk works is when there's risk off, the money move from small cap to large cap. So large cap do really well, which has been happening in the last 6 months or so. And when when there's a trade deal and then where the world looks like it's progressing towards global growth again, certainly that flow will start going down. Risk on, start flowing down to the small, to the micro caps. That's when you see strong outperformance. At this point, it's a bit hard to see because all these uncertainties globally. But one thing interesting, as you brought it up, we should touch on, is that when the first tariff was introduced, the 10% late last year, market went through a bit of wobble, and the company earnings has actually went through a bit of issue. However, with the stimulus from both sides, US and China, we actually see the corporate profits as well as some of the data actually started to improve before we had the second round of 25% that hit in May. So, if we even stay as where it is, without further escalation, we could actually see the earnings improve into the end of the year, which is supportive for that risk-on scenario.
Okay, so the last question, Jun Bei Liu. We've got two questions.
Of course.
Second last question is, when do you see a global recession that could really hurt the stock markets right across the globe?
Look, I think the full-on global recession is definitely not in sight this year. You're probably looking into more 2021 and further out, simply because all the central banks are sitting there going, we will do whatever it takes. We'll cut rates, we'll punt liquidity, we'll buy back, but support the bond markets to give you liquidity. Now, this creates problem further down the track. 5 years, 10 years, social unrest, all these issues. But for the short term, it's going to support whatever challenging economy condition that we are going through. You look at Australian economy, things were pretty tough ahead of the election in May. And when that election took place and stability came through, and then RBA cut and will potentially get another cut tomorrow, and then we approach making adjustment, they are hoping that to slow down the fall. And then we're seeing somewhat response across the housing market. But look, it's not going to bounce back, but it probably just stop it from becoming worse.
Dodging a bullet.
That's right.
Okay, now, last question. What stocks do you like now?
Look, there's one stock actually we think will do very well in the next even few months or so. It's being left behind in this rally. ALQ, the company has had an incredible, it's a testing business that it tests minerals, tests environmental
testing.
testing.
Services company?
It's a mining services company, but quite a big part of their earnings also come from environmental testing as well.
So it's
that's diversified, has very good global diverse exposure, and one of the largest players across those markets. Lately, we've seen gold prices going through the roof. Generally, how it works is when gold price through the roof, junior gold miners will go out and raise money, and then they start doing testing and go out exploring. And we've seen that start seeing early sign of it, and this company is a big beneficiary of it. Trading at a big discount to the global peers, huge amount of M&A taking place in this space. So if the company earning doesn't get recognized and upgraded, the company will get bought out. So it's a great company to be in. ALQ.
That's Jun Bei Liu's hot tip. And of course, Jun Bei Liu is a portfolio manager at Tribeca Investment Partners. Well, this is my weekly catch-up with my good buddies from the stock market arena, namely Julia Lee of Bell Director, Michael McCarthy of CMC Markets. Guys, how are you?
Hello, Peter.
And this week I've changed it. Rather than looking for winners and losers just generally, I've looked at the companies, top 100 stocks who really had a shocker last year. We'll show a table so people can see it. But I then looked at FN Arena and what the analysts were saying, and a lot of these companies, they're predicting pretty big comebacks. And I want to see what you guys think about these companies. You know, when I add experts to experts, it gives people clues about what's going to happen. Okay, so let me quickly go through it. Okay, AMP guys, yes or no?
No. Not with your money, Peter.
Okay, Boral Limited.
Yes.
Same. Blue Scope.
Yes.
No.
Yeah, we kind of tipped it a few weeks ago, and it's gone up, hasn't it already? Challenger.
No.
One of my favourites, absolutely.
So we're getting a nice variety here. Computer Share.
No.
No.
Caltex Limited.
Yes.
No.
What about CYB? Just because it's Clydesdale Yorkshire Bank, hanging on a Brexit deal, I guess.
Yes.
Trader's favourite. Investors less impressed.
Okay, look at that 29% gain if we get it right. All right, Domino's Pizza.
No.
Yes.
Yeah, you're going along pizza watching Manly play football, aren't you?
Absolutely. For the cold winter, here we
It's
go.
too hot in Europe at the moment. Who eats pizza when it's 40
Do you
degrees?
think the Italians are going to stop eating pizza just because it's a bit warm?
Yeah. Ice cream. Go long ice cream, short pizza.
Go on both.
As long as there's beer, I'd eat pizza. There's no problem at all. Flight Centre.
Yes.
Yes. Like
It's a
this one.
company that always does better when everyone thinks it's not going to do better, doesn't it? Out of the blue, it just starts doing well, doesn't it?
Well, I think of it as the silver nomads. And, you know, when they thought they were going to lose their franking credits, not only did we see downgrades from caravan companies, and I guess Flight Centre is the silver nomads of travel agency of choice because it is bricks and mortar.
Yeah.
So, look, I think we will see a bit of a bounce back in Flight Centre.
Big pullback from 72 to 40. See value here. We often hear arguments there's no value in the share market. Well, you have to have a little bit of courage to take on some of these. But if you have faith in their business model, it's a very attractive share price in my view.
And Screw Turner has a habit of proving people wrong, doesn't he?
Absolutely.
Yeah. By the way, he's the CEO of the company, in case you thought I was being rude there. All right. Now, okay, James Hardie.
Neutral.
I like it for the same reason I like Boral.
Okay, we'll come back to that in a second. Lend-Lease Group.
Yes.
Nope.
It's been a real struggle. Now, Link Administration. I love John McMurtry. He's a great CEO. London has made the business a bit tricky.
Yes.
And analysts think a 39.9% comeback. What do you think, Julia?
Not this year, maybe next year.
Okay.
High risk, high reward.
You like it?
I would
High risk, high reward. Okay.
Yes, that's what I want to say there.
Okay, good point. Good point. I must admit, I agree with you, Julie. A 2 or 3 view, I'm sure they'll make a comeback, particularly when Britain gets settled in some sort of post-Brexit zone.
I think maybe more pain in the short term.
Okay, Michael, you want to add more to your?
Look, they really need to turn this around, Peter. The performance, particularly in the UK, has been terrible, to be frank. The numbers are awful, and the stock was smashed after their profit warning.
Yeah.
A longer time frame, I like it.
Okay, Nine Entertainment Group.
No.
Definitely not.
Okay. All right, guys, but Origin's a controversial company.
Neutral, not strong either way.
I don't like it. I think it'll be squeezed.
Okay, let's go to Oil Search now.
No, I'd much prefer a Beach Petroleum in the space. I just don't like the politics of Papua New Guinea at the moment.
Yeah.
One of my top long-term picks. I don't think the Papua New Guinea government can afford to move against them. Like it, and I like the Alaskan expansion.
There you go. All right, let's go to Pendle Group. That's the old DT, isn't it?
So yes from me.
Yeah, it's a reluctant yes from me. They've got work to do, but geez, it's an attractive share price.
All right, fair enough. Qantas.
I think this one will trade sideways. So I think it's very much range bound and will continue to be.
Not for me, and I think there's huge event risk in the industry, and for that reason I wouldn't hold it.
Volcanoes worry me with airlines. When you got that kind of curveball out there, that does worry me. What about Reliance Worldwide Corporation? Was a great company. It's really been bashed around lately. Can it make a comeback?
Look, it was a market darling for a while there. I think both Qantas and Reliance are the two that are very clearly range trading at the moment. So I think that will continue until you see a catalyst for it to move in another direction.
It's a 34.7% gain. Even if they went up 5%, some people would be happy, wouldn't they?
Absolutely. I like their technology, but I find it hard to buy given the number of times they've blotted their copybook.
Okay, Centre Group, one of the few that actually has a small 4 minus 0.2 flat. What do you reckon?
No, staying right away from shopping centres still. Structural move.
Boring.
All right, well, something that's not boring, gambling, Star Entertainment Group.
Oh, not in the short term. However, it is in those hot tourist pockets of Sydney, Gold Coast and Brisbane. So I think once you start to see those tourism numbers come through, I think this is one that is cyclical. So I'd wait 6 months for the Star Entertainment, just like I would some of the other tourism exposed stocks like Experience Co, which have been under pressure because we're just not seeing as many visitors.
Michael?
I like it, and I think it'll start moving it the closer we get to the opening of the new casino. A lot of people think that will be bad news for Star. I actually see it as a positive because it becomes a draw for international gamblers.
Okay. All right, TWE, Treasury of Winestones.
No.
Yes. And it's not just that I like their product, Peter.
No, I wouldn't have thought so. Now, this one, a lot of people wouldn't even know what we're talking about. Unibail, Rodamco, Westfield.
No to shopping centres again. These are shopping centres across Europe as well as the US. I think that structural trend
Must be the best
again.
collection of shopping centres.
Yeah,
one of the best in the
wonderful.
world,
But
shopping
everyone's
centres.
going digital, and you know, everyone's. Actually, we just heard that H&M is going to decrease the number of stores by 45 stores down to a net of 130. So that bad news flow keeps on coming.
They're tenants, aren't they?
Yeah.
Michael?
Westfield?
Yeah.
No, same deal.
Okay, let's go to Whitehaven Coal. Can coal survive all the people out there who don't like this product?
Look, coal has been under pressure, and Whitehaven coal is mostly thermal coal. I think we'll start to continue to see gas prices fall, and I think that's going to get into some of the other commodities as well. So a no from me, Whitehaven.
It's a yes for me. Similar reasoning though. I think we're seeing the extreme of sentiment against these industries. The reality is we cannot simply walk away from these industries. That will become more and more clear. And once it's very clear that not all Australians hate coal, stocks like Whitehaven will benefit. No, I like it for that reason.
And finally, now this is a company that has a history of disappointing, and Worley Parsons.
It's a yes from me. The new acquisition should show synergies, so they should do pretty well, I think, this financial year.
And just as iron ore prices have outperformed analyst expectations, so has crude oil, and Worley are a leveraged beneficiary of that. So yes for me too.
Okay, right. So we've gone through it. You've got, you can see on your screen the companies that have some enormous potential gains. Now I drill down to the ones that you guys really like, and you would put your money on it and your reputation and all that sort of stuff. So Julia, why don't you go first?
Look, first of all, stocks like these are some of the worst losers of the last financial years. You're really counting very strongly that there's a turnaround story. Otherwise, it's very easy to see an additional 15 to 20% loss. And
Another leg down.
actually, it's quite a difficult thing to do to pinpoint the turning point and have a real success story. So it is a difficult thing to do. But some of the things that I look for is not only how the fundamental, the valuation side of things, but what the catalyst might be and also what cycle it's tied to. If it's simply a cyclical stock at its lows, then I like that type of company. So I'm obviously staying away from AMP because there's probably still a lot more work to do, and I can't really see the catalyst there for AMP, but liking something like Flight Centre, you know, the franking credit uncertainty is out of the way at the moment, and you're probably going to see a bit more of a bounce back there.
Okay, so there's one you don't like, one you do like. Is there any other stock on that list that you really like?
Yeah, a lot of the cyclical ones I do like if they're just completely at a cyclical
Well, name
low.
names. My people want
some
names.
of the building product companies. I mean, Lendlease, the catalyst is quite clear there. The engineering business, which is for sale, if they were to offload that, that would be a positive catalyst. And having a look at some of the companies like Boral, that's also tied to the building product cycle, but also the infrastructure cycle, which should really help to underpin the strength in that business. And BlueScope Steel, where we're probably seeing a bottoming out in terms of steel margins as we speak.
Okay. Now, Michael, you.
Well, declaration, Peter, I've owned Oil Search for quite a long time now and will continue to do so. My view is that in a carbon-constrained universe, gas is the answer, and I really like their reserves. They will fluctuate around $7. I'm very happy to nominate that as an entry level, but it is a long-term play. I've recently bought Challenger. And the reason for that is their sensitivity to a lower interest rate environment. I haven't seen a reaction in the share price that reflects that. The last result in May was terrible, let's be frank about it.
It's been a great jump in the past.
It has, and there's real talent there, and their annuity products come back into favour in a lower interest rate environment. So I think this one's on the turn. As I say, I bought it recently. And the one I'm examining at the moment is Treasury Wine Estates.
Is that because you like liquid assets when you actually practice?
What a great dad joke. Yes, well, there is that, but also this one has been hit hard on an analyst call that they're going to have further supply chain problems. Now, my experience in this space is that when a company has problems with a particular area of their business, and remember the terrible time they had with their US supply chain, I don't think they're going to make the same mistake. And I think that analyst is off beam, and the share price reaction we've seen after that report was released puts it in a good place.
All right, here, I'll throw you a curveball question. If someone looked at this and said, because you like, for example, Domino's, and you don't like Domino's, but if someone put together a portfolio of all these losers that the analysts say will be winners, A, would they have pretty good diversification, and B, would it be likely that portfolio would do well over a year or two?
If you took the top 100, and I guess this is a list of just over 20 stocks, and took the 20 best performing stocks and the 20 worst performing stocks, I would bet my money that the 20 best performing stocks would perform better in the next financial year than the 20 worst performing stocks. And that's because trends tend to continue for a long period of time. So some of these companies, yes, there's value depending on your time frame and when the cycle turns in favour of these businesses. But I mean, we were talking about AMP and whether that was a potential buy 6 months ago. It's still trading near an all-time record low. And, there is no catalyst inside, whereas some things like Lendlease, Flight Centre, I think there are clear catalysts for. Clydesdale, I think there's a clear valuation mismatch between, the value of the business and what's happening in Brexit, which is more of a short-term thing. And something like Computershare, well, they are exposed to lower interest rates. So why would you jump in until you could see a clear path to higher interest rates where there'd be a tailwind behind their business rather than a headwind?
Now, I'd like to say, well, that's the view of a very conservative woman, but we know that's a complete lie. This is not a conservative human
An
being
experienced
at all.
investor, I would know.
But Michael, what would you say?
Well, I am more inclined to roll the dice. I have a very high risk appetite. I'd point out, first of all, on the list that we've looked at so far, there's no banks and there are no major miners. And they're two very important components of the index. So this portfolio would be very unlikely to perform the same way as the index. That's not necessarily a bad thing.
No.
Investors
It could be a satellite outperformer, couldn't it?
Investors who want extraordinary returns have to be prepared to do extraordinary things. And that's one approach that could pay off. Now, the reality is, I'd say out of this list of 20 or so companies, 5 or 6 are going to do extraordinarily well. And a couple of them could do terribly. So how that plays out really comes down to the numbers, how many perform and how many don't. But for those investors who are looking to juice up returns in a low interest rate environment, that's what a lot are looking to do, that could be a good approach. And I like the idea of doing it as a portfolio, diversifying the risk, but still giving the portfolio the chance to deliver something extraordinary.
Yeah, so if they had effectively 20 of those stocks there, they would have a 5% exposure to either a dumb CEO or a bad government decision or something like that.
And the whole premise of this, taking the underperformers in the market, is off the whole premise that the market tends to overreact and underreact. And it tends to overreact on the downside as well as when things are going really well. So often it becomes too pessimistic and you sort of start to see a bit of a mean reversion happening at some point in time.
I got to say, it's probably in my interest to put a few thousand into this, and we'll watch it over the course of the year.
I'll take the opposite and the best performance, and we can.
No. The best performance is the way I usually do. But this would do it me being really outside the square.
No,
Julia
some interesting
Lane,
companies.
Bell Direct, Michael McCarthy, CMC Markets. Once again, thanks for joining us.
Thank you, Peter.
Coming up after the break, we'll be talking to Peter Morgan, one of the best stock pickers in the history of Australian stock markets. Peter Morgan, thanks for joining us.
That's right, Peter.
Now, I've invited you on because I'm regularly reading you on Twitter nowadays, and you've always been, ever since I've known you, reasonably controversial. Were you always controversial, or is it something that grew on you as you become a doyen of the industry?
I'm not. I mean, I think it's like anything, Peter. I mean, I think, particularly in investment markets, it's you make your best decisions and your best money making decisions when you're against the herd at times, and there's a part of that in it. And I've always had the opinion if I don't like something, I'll stand up for it. And a lot of that went back to when we were at Perpetual, as the money grew and grew in terms of what we were managing. You can't do the Wall Street walk and just sell. So we had to learn to fight in a different way. And investing is a lot like a sport. You do have to fight, and you do have to. I don't mean that in terms of aggression, in terms of hitting someone or something, but I mean you've got to stand up and fight at times. And the first real battles we had at Perpetual against like the AMP, and we'd go to AGMs, and it just wasn't me. It was Matt Williams and it was John, and what you tend to find on, the only reason I'm really on Twitter is because I just want to learn a little bit about, the internet and social media and that sort of thing. But it does provide an information base, but it can become very, very hurdle and very one-sided.
Do you think that there's a lot wrong with companies in Australia, given the fact that I talk to a lot of amateur investors who are trying to run their own self-managed super funds? Do you think there's a lot wrong with companies and investing in Australia?
Well, it's a hard question to answer. I mean, I think that regulatory-wise, it could be better. When I started at Perpetual in the early 90s, the quality of Australian companies in number was a lot better. A lot of them have been taken over. A lot of them are great traditional old family companies that had been through cycles and the like. And the other thing that's happened, obviously, in the Australian market is that superannuation's come into it, and super's fast approaching $3 trillion. There's still roughly an allocation of 25% to Australian shares. The big super funds are now at a position where they're gigantic, not only in an Australian sense, but in a global sense. I mean, Australian super, for example, I can still remember when they were $3 billion, and I was managing money for them, and today they're probably $160 billion, whatever the figure is. And all that's changing. A lot of that money is going in-house. But getting back to your question, the obvious thing is the Australian money has to get overseas, but we're also in an environment, and this is, again, something I'm trying to point out to those that will listen, is that we're in an environment where interest rates have never been this low, and risk has been forgotten about, I believe. And you just can't go on cutting interest rates and building debt, not only locally but globally, without that risk coming home to bite at some stage. And that's the thing that really scares me. I mean, I honestly think we're in a situation here in Australia and globally where there's a 50% chance at least it could all go pear-shaped. And then, the central banks around the world haven't got the capacity to cut and build confidence like guys like Bernie Fraser did in the early 90s when, we went through the recession we had to have, as a way of an example.
But Pete, we've been spoilt in the sense that we haven't had a recession here for 28 years. So when people write to me and say, a crisis is coming, I think, well, crises tend to come every 10 years anyway. That's the kind of logic that you would have employed when you were a fund manager, wouldn't you? That, you know, you look at the history of stock markets, over a 10-year period, you can make about 10% per annum. Half of that comes from dividends. Of course, that 10-year can be 12 years sometimes or 8, but it works out around 10. The fact that we've got lower interest rates, doesn't that make you think that, all right, this is just stretched out, this bull market, but one day a crash has to come? And things get sorted out.
Well, they get sorted out, but there's pain. But you know, the thing, as I said, the thing that really worries me is we haven't got an institution like a central bank, not only in Australia but around the world. Although the Fed, you know, and Canada have had the ability to raise, that can offer support when we need it. Like we're almost talking ourselves into a recession here in Australia, and. You know, it's a cliche, but you know what Buffett says with regards to greed and fear is that he'd rather be fearful when people are greedy and greedy when people are fearful, and that plays its part. You know, you talk about, I think that hides a lot here in Australia, that 28 years of recession. You know, it's based around population. It's based around what we dig out of the ground. It's based also around what we've built above the ground, but also we've had interest rates that started in 91, 92. You know, you remember them. You know, they were almost in the 20s.
Yeah.
You know, and the ceiling on a housing loan or a mortgage loan was 13.5%. If you know, and then it started pushing above that outside it. So I'm not saying we're going back to that. And actually, in fact, the leverage in terms of volume is more risky today, I think, because interest rates are so low. So the risk in terms of volume pressure, rather than just the interest rate, is greater for any. And we may get to the stage, and I think we are at the stage, where the Reserve Bank's getting itself into a position where it's going to be in a very difficult position just to raise rates. Yeah. And that's the one thing I like about Powell. Like I like, at least, not about the Fed, at least they raise rates and now can come back. And Canada can do the same. And, you know, some today are again talking about us being at, 0.75% this time next year. Well, that puts us on a par with the UK. It puts us right down there. And supposedly we missed the GFC. So I'm not quite sure. And again, a lot of this has got to do with politics, Pete. I mean, there's no vision in Australia. You just can't go on relying on property. I mean, it's just stuff you dig out of the ground.
Okay, so given your concerns, and you seem to be saying, I'm concerned.
I'm not saying it's happening tomorrow.
No. Are you still invested?
Well, I'm still invested. I'm investing my own money. But again, I'm in the position like any retiree in Australia, any billionaire in Australia, and I'm not a billionaire, but I'm just saying, with interest rates, or let's say the 10-year bond rate in Australia today is below 1.5%, right? 10 years ago, when that bond was issued or in the marketplace, 10 years ago it was at 5%. Now, if you held that bond and it's running off today, you've now got the alternative where you put the money. Yeah. Now, the only real alternative you've got is you either leave it in the bank or you go out into the marketplace where there's, as I said, $3 trillion worth of superannuation, and you increase your risk profile in a market where asset prices are quite high, particularly around the world and in the US.
Do you, given that, do you chase quality companies that have a history of paying dividends? And why I ask this question is people have believed that when stock markets crash, as we saw in 87 and we saw in 2008, share prices slump, but dividends held up pretty well. And so a lot of retirees are saying, well, I can live with my capital going up and down as long as those quality companies don't disappear and they keep paying reasonable dividends. Is that a reasonable goal to have as a retiree?
Pete, the biggest thing when you're investing, you've got to remember that earnings and free cash flow pay a dividend, right?
Yes.
Now, we're in an environment over the last 15 years where the payout ratios of Australian companies have gone up markedly, right? So the amount of earnings that's being paid out in dividends, and it's a factor of franking as well, is quite high, right? Yeah. The balance, conversely, Australian corporate balance sheets away from the financials are reasonably solid. But the fact is that earnings pay dividends. And strictly speaking, free cash flow pays a dividend on a recurring basis over time. So, I think investors have to be aware of that. There's been plenty of examples where, Telstra's dividend has been cut recently quite hard. So to rely just on the dividend not being cut, I think, is a fool's paradise. the most important thing you should be looking at is, is how the company's going, earnings wise, and the cyclicality in those earnings. Again, it's sort of a cliche, but the type of investor I am is that it's sort of similar to Peter Lynch, where you classify your company whether it's a cyclical or it's a mature company that has got a recurring earning stream that's quite maintainable, or it's an asset play and like, and it's not every company's the same as well. So I'd be very cautious. Just don't buy a company because it's on a 5% or 6% yield.
Yeah.
And if we just look at, it's still one of the biggest sectors in the market is the banking sector, right? Now they've obviously been belted around because of the Royal Commission and property and the like, but investors should also keep in mind that the bad debt charges of the banks have never been lower, and their payout ratios, strictly speaking, have never been higher. Now, at some point, that will break.
That's a good thing. The first part's a good thing, isn't it? The low debt rates. Yeah.
Well, the bad debts are zero. They can't go any lower. I mean, again, I'm coming back to the thought that I'm trying to paint is that when things are really good, you've got to start asking questions. How long does it go on for? Yeah. And the banks can't go to negative bad debts. I mean, I don't care what you're saying. Not you particularly, but what the market says. You just can't assume it's going to be zero bad debts forever. And what happens, what we saw in the early 90s is that when bad debts hit, they hit quite hard. And it wasn't on the household side. Then it was the corporates like Alan Bonham and Christopher Skase, who the banks irrationally lent to. I think the actual, just talking about the Royal Commission, I think it actually came at the right time. I mean, it sorted a lot of it got on top of even though there hasn't been much follow through with it, it brought to light some of the crazy stuff that was going on.
What about the fact that the Royal Commission has resulted, and APRA, have resulted in the fact that a lot of good borrowers can't get money? It's all very well looking at the overall debt and say, that's too high, but for an economy to do well, good borrowers have to get money.
That's one of the fallouts of a regulator not doing the job that they should have been doing in the first place. I mean, if they would have done that, again, there's another saying, there's only one thing worse than no regulation, it's poor regulation, because the poor regulation breeds confidence not only in the people borrowing money, but the organisations it's lending to. So, I'd put to you, if the regulators would have done their job and we didn't have a Royal Commission, you'd be back to the normality. Now, that will adjust. Banks still want to lend to grow their profitability, and they will lend to the better ones as it passes through the system.
Okay, Pete. I know that you and I could wax lyrical and negative about all the things out there that are worth worrying about. Yeah. But at the moment, are you fully invested?
I'm reasonably invested. But I'm conservatively invested. Yeah. I mean, the other thing just to keep in mind is that while interest rates are low, the pricing of bonds and the like can actually go up. I mean, we're sort of in an environment where everyone thinks that interest rates are going to continue to fall and bond prices are going to continue to rise. Well, that can actually go the other way, and it can hurt pretty bad. The type of things I'm buying at the moment, by way of examples, there's quite a few listed investment companies that listed over the last 2 years, 3 years. Yeah. You went through that phase where everyone wanted to do a listed investment company, and there was billions raised. Now, a lot of those listed investment companies where not only can you see the net tangible asset backing on basically a daily or weekly basis, but they've got reasonable management. The regional managers that I know, but a lot of them are trading on discounts now of between 10, 15, up to 20%. Yeah. And I think it's just it. And I'm still, as I said, I'm cautious on the market in the sense this froth, particularly in the not only here but also in the US, where you're getting companies almost on a daily basis listing or coming to the market, having gone through 3 or 4 pairs of venture capital, private equity hands, but not making any money, and that speculation being in the market, and people playing, investors in the US playing the game of pass a parcel basically. Again, I think that's dangerous. But coming back to what I was saying, I think I have been buying those listed investment companies that are trading at big discounts. Sure, if the market falls, the prices will fall, but you are somewhat protected by the fact that they're trading at such a big discount, and you can see what companies they're investing in.
Well, Jeff Wilson said to me a couple of weeks, he said, my whole life I've tried to buy $1 for 80 cents.
Well, you can do that.
Yeah, that's right. But sometimes, and Jeff was the opposite, people love WAM Capital so much.
I know.
It's been traded at premium.
And that's why he uses his scrip as a currency. That's fine.
Yeah. And he wouldn't even put his daughter in WAM Capital, he said, because it's just too much at the premium.
I haven't heard that, but that's what you're saying.
He said it on this program. He said, but the bottom line is, some really good licks remain at a discount for a long time purely because they can't get the market to actually.
Well, but that's the opportunity. I'm happy.
How does the catch up? Because for you to make money out of this, you'd like to see it go into ultimately premium at least, wouldn't you? If it went
I'd like to see this. I'd like to see the discounts shrink. And I mean, you're talking about, Jeff. There was a listed investment company called Wealth Defender over the last, going back 2 years, right? That John Murray and Perennial did. And it traded at, again, a 15% discount, and someone like Jeff came along and decided to take it over and mop it up. Now, that can happen, right? There's nothing...
Because the NTA made it so attractive.
The NTA made it so attractive. And there's, again, and I'm not saying I'm going to do this, but others can do it if they want. You can get antagonism where that discount stays. You can get activism where the discount stays so big. Now, I could quite easily put to a supposedly an independent director sitting on one of these LICs that, why in the hell are you doing a discount on a DRP at a discount and not buying back shares to shrink that discount? And, there is... Play's not the right word, but there is a level of activism that could occur there where you said, well, if you're going to be an independent director, you should be looking after the investors you're representing, not the fund manager that's running the operation, i.e. trying to keep their funds under management high, so the management fees high. So there's various things that can play out, Pete. All I know is if I'm buying something that's worth, I can see it in the face of me with no debt, $1, and I'm buying it for 80 cents, I mean, at some point, that discount will shrink. And it may not be tomorrow, it may not be in a year's time, but I'd rather be in that than be in something that doesn't make any money, that, whether it's, a meat company or a taxi company that is churning through money left, right and centre with no visibility with regards to making not only earnings but also paying a dividend. Well, I'd rather do that. That's my style.
Can you name one of those licks so my viewers know what you're thinking?
I can, but I don't. This is not a recommendation. They have to see their own advisor.
Yeah, of course.
Look, you said Jeff's. I've been buying a few of his global fund. Ashok's got Elliston out there, and I can't pronounce the name. The Antipodes one that is also a global run. Right? Okay. Now they're all. I'm gradually just building a stake in them, right? Now, as I said, I'm a little bit concerned. I am concerned about markets, full stop, in terms of the music could stop at some stage, but I have got some downside protection. But I've got to say to you, I can look after myself. I can't look after, others. Yeah. In market, look, I've always said in markets, as a fund manager, you're doing a really good job if you get 7 out of 10 right? Now, even if you get 5 or 6 right, because companies can go up 200% rather than just lose 100. You're doing a reasonable job. So I don't know which ones are going to go up. I don't know what investment calls are going to be right, but that's where I am. So
one last thing before we wrap up. I want to take down memory lane. So when you left Perpetual, you started 450.
Yeah, 452 capital.
452 capital, and that was based on.
Well, that was based on Bradman's high school.
I mean,
you set up.
But a lot of people don't know this, and that's why. But the thing is this: what's staggering me about your story. How many dollars did you get even before you opened up the door?
Oh, we didn't have anything when we opened up.
Yeah, but
mate, I can tell you,
it didn't take you long.
There was 6 months over Christmas when we'd signed a big lease on Australia Square.
It was you and Warwick, was it?
It was me and Warwick, and when we signed the lease there over Christmas, where we thought, is the money coming or not? And it was also at a time where it wasn't as competitive as today in that marketplace, and it eventually came and. Between 2001 and 2008, it got up to $9 billion at one stage, and that's just a hell of a lot of money. It's like, funds management's like a racehorse carrying weight. The more weight you carry, the more handicapped you are in that. And that's the point I'd make to the industry funds or people in industry funds today. Those big returns you saw previously, and that there's a lot with regards to fees, but there's also a big factor in the fact that they carried a lot less weight 10, 15 years ago than they're carrying today. And that brings together with it the risk of that weight and also, where that weight gets positioned. So.
Okay. Do us one favour, that if you do get scared, will you give me a call so I can tell all our people as well?
There's a lot of people that have called the top and
I know.
ended up going over the cliff before the top has been reached. So,
Yeah.
I mean, I'm not, but you've got to, but you can't, the other side of that is you can't, I'm coming up in a position where I'm psychologically a pessimist.
Have you always been that way?
I have been, and I've heard also people say to me the best fund managers are the ones that are pessimistic, and I don't. Only because it's the thing you got to remember with funds management as well is that it's other people's money. Like it's, and as Ivan Lendl used to say, he hated losing more than he did love winning, right? And that's what investors are like. They start losing money and they hate it. It's all right to win, but the other thing is to lose. And I've always had that opinion. I don't. And when I'm investing today, it's my capital and my money, and I've got to, protect it.
Pete, thanks for joining us.
All right, thanks, Pete.
That's Peter Morgan, legendary fund manager, who now masquerades as a very normal person.